There's a lot of talk in the business world about running your property at a loss just to claim negative gearing. But what does that mean exactly? And is it something you should be doing with your business? In short, running a business at a loss means operating your business at a net loss. This means that your operating expenses are greater than your revenue. And in this video, we'll discuss what it means to run your property investing business at a loss and other reasons why you might not want to do it. And hopefully by the end of this, you can be well on your way to learning how to treat property like a business. And if you haven't already, make sure you click on the follow button below and also let me know your problems in the comments you have on your journey and I'll create a video for you. How much effort will you put in? What are you willing to do to get there will determine how far you go. A little bit about me. I'm Scott Lavoon. I'm the founder of Wealth Through Property. I started investing in property at the age of 30 years old while working a full-time job as a tradie. I wasn't on a big income, and within the space of 3 years with the right mentors, I was able to build a system where I was able to retire with over 10 properties and over 100,000 in passive income. There are a few reasons why someone might think this is a good idea. For one, they might believe they can deduct their losses from their taxes. And while it's true that you can deduct the business losses on your taxes, are you really losing more money than if you bought a self-sustained property? So why would you choose this method if you're really losing money? Is it unreasonable to think that you might be running your business at a loss because you don't have the right systems and strategies in place? Are there other ways to structure your business so that it can run more efficiently without relying on negative gearing? There are many factors to consider when determining whether or not running your business at a loss is the best approach for you. I just want to make this clear that negative gearing is not a strategy but an outcome. Negative gearing is used by investors to minimize their taxable income. It's achieved by owning an investment property and renting it out for less than the mortgage repayments, insurances, and other associated costs with ownership. The loss incurred each year is then offset against any other income earned, such as salary or wages. Negative gearing explained in simple terms. Disclaimer: the figures below are for demonstration purposes only and does not constitute financial advice. We recommend consulting a professional before making any financial decision. Let's say you purchase an investment property for $500,000 with a 20% deposit of $100,000. This leaves you with a $400,000 loan. Assuming the interest rate on your loan is 5% and an interest-only loan, your annual mortgage repayments would be $20,000. But that's not all you have to factor into the cost of ownership, such as insurances, council rates, and maintenance fees. Let's say that these come up to a total of $5,000 per year. This means that your total cost of ownership are $25,000 per year, so $20,000 plus $5,000. And if you're only able to rent out the property for $18,000 per year, you're running at a loss of $7,000 per year. So $25,000 take away $18,000. The idea behind negative gearing is that the loss incurred each year can be offset against other forms of income, such as your salary. So if you earn $50,000 per year and you make a loss of $7,000 from your investment property, your taxable income would only be $43,000. So $50,000, you take away the $7,000. Now, let's imagine your rent is $25,000, which covers all the expenses. In this case, your investment property is not running at a loss. So you're not running at a profit either. So in an instance, you are not going to get further tax savings as your rent is covered against the expenses. So before choosing this approach, it's important to consider whether you are saving $7,000 or are you losing $7,000 in potential earnings. Running your property at a $7,000 loss means out of your wage, you're going to have to add an additional $7,000 to support the loan and expenses. Let's imagine that your tax rate is at 50%. Using the lesser rent example of $18,000, because you have used the $7,000 out of your wage to support the rental property instead of paying tax on the $7,000, you have saved $3,500 in the tax you would have paid on the $7,000. This means that you have saved around $3,500 in tax that you wouldn't have paid. But have you saved $3,500 or have you lost an additional $3,500 of income? So it's not unreasonable to think that you are wasting money to save on tax. Think of it from a perspective of running a business. If your business is making a profit, that's great. But if your business is running at a loss, it's not so great. In fact, it's probably not sustainable in the long term. It's quite sad to think that time and time again, professionals or high income earners would do anything for a tax deduction, yet they would never consider running their businesses at a loss. Is this a lack of education for high income earners? Or are the professionals like accountants out there so focused on reducing taxable income that they forget that they're actually earning less money? It's funny that most people assume because someone is a high income earner, they must completely understand the best ways to reduce their taxable income. Or you go to some random accountant who has never actually achieved anything fantastic themselves and taken their advice and end up losing money. Being a high income earner, unfortunately, doesn't mean you're going to have the education to make the right decisions with your money. There are many professionals that have little or no understanding of taxes and deductions, which leads them to making bad decisions, which are the risks of running your business at a loss. There are a few risks associated with running your business at a loss. For one, it can put strain on your finances. Is your other income guaranteed? What if you lose your job or have an unexpected medical expense? In addition, running your business at a loss can also lead to burnout. When you're constantly trying to make ends meet, it can be easy to get very overwhelmed and burnt out. This can lead to poor decision making and can even lead to your health at risk. So why do high income earners and everyday people get preyed upon? Think about it. How do people sell products? They typically use some form of marketing, whether it's online ads, TV commercials, or even just word of mouth. And what do these marketing strategies have in common? They all target people who are vulnerable in some way. For example, who likes to pay tax? Nobody. So when a tax accountant comes along and says, hey, I can help reduce your taxable income, they are targeting people who are vulnerable to the idea and saving money on taxes. The same can be said for negative gearing. It's marketed as a way to save money on taxes, but in reality, it's a way to lose money, and yet people still fall for it. Why? Because they are vulnerable to the idea of saving money. So next time you're considering negative gearing, or any other financial decision for that matter, take a step back, ask yourself, am I being preyed upon? If the answer is yes, then it's probably not a good idea. Could I have built my portfolios quickly if I negatively geared? Time and time again, you've heard that capital cities are the only places to buy property, and as the growth is higher. You might have even heard that you should only buy new properties as they grow quickly and can claim negative gearing and depreciation. As I previously stated, I'm a firm believer in building a portfolio that suits your own personal goals and risk profile. With this being said, if your goal is to build a portfolio quickly, then negative gearing is not the strategy for you. Think about it. Where are most people located? In capital cities? And where is it easy to sell a house? Where they are located. The thing about property, unlike shares, is that you can touch it. People feel more comfortable buying something they can physically see. It's like the mentality that new is always better. You know, for a start, on a property, what appreciates in value and what doesn't. Land appreciates while the building depreciates. These days, it's a myth that capital cities increase at a value at a higher rate than regional areas. If you're looking at the data over the past 20 years, there have been plenty of times where regional areas have outperformed capital city market. The other issues with trying to build a portfolio quickly is that you're more likely to make mistakes. When you're rushed in, it's easy to overlook things and make rash decisions. This is why it's important to take your time and do your research before making any investment decision. If I negatively geared my portfolio, I would never have been able to buy as many properties as I have. Without cash flow, there were only so many properties I could afford to buy. And as I always say, cash is king. Having a strong cash flow allows you to weather the storms that inevitably come with a property investor. It also gives you the flexibility to take advantage of opportunities when they arise. So if your goal is to build a portfolio quickly, negative gearing is not the strategy for you. Instead, focus on building a strong cash flow and diversifying your portfolio across different markets. What are the benefits of positive cash flow properties? There are many benefits to having positive cash flow properties, and the two main ones that it gives you financial flexibility and helps you weather the market downturn. When your portfolio is generating positive cash flow, you have the flexibility to take advantage of the opportunities as they arise. For example, you might not be able to buy an extra property or two when prices are low, or make improvements to your properties that will increase their value. Positive cash flow also helps you weather the market downturns. If the rents start to fall or vacancy rates rise, you'll still have enough money coming in to cover your costs. This means it can help you avoid having to sell your property at a loss. So if you're looking to build a strong portfolio that will withstand the ups and downs of the market, focus on generating positive cash flow. I really hope you've enjoyed this guide on how to start when looking to build your team and start your property journey. Please follow, like, share, and comment if you got any value, and stay tuned for more.